159,000 tech workers laid off in 2025, 2,700 stores closures announced. The Fed just cut rates again in November, 25 basis points after a 25 basis point cut in September. So it's 50 basis points in back to back months. And here's what nobody's telling you: core inflation is still stuck at 2.7%. That's 35% above the Fed's target.
Well, Kevin, wait. If inflation's still high, why is the Fed cutting rates?
Because, Matt, after so many years, it's being,
We don't need to put a number
yeah, we
on
don't want to put a number.
that.
You know, being in New York, trading bonds, working economist. Yeah, I've seen this movie before more than once, and it never ends well. The Fed just made a choice here to protect jobs now and risk inflation later. And if they're wrong, retirees pay the price.
What kind of price?
Treasury yields are rising despite the Fed's cut. The bond market's calling. What that means is the bond market's calling their bluff. So typically, when the Fed cuts the rates, the Treasuries yields drop as well in unison, but it's doing just the opposite. And so what that can mean here is financial conditions here are already loose with equity prices at way evaluated valuations and and the retirement plans that most Americans are counting on, they're about to get squeezed from the different directions, I think, all at once. Fed cuts killing their income, tariffs raising that one-time cost,
Mhm.
and a potential inflation resurgence that could force the Fed to reverse course completely.
Well, wait. I thought Fed cut rate or Fed rate cuts. They're supposed to help us.
You know, Matt, through all the times I traded bonds through these Fed rate cut cycles, here's what the FOMC minutes from this November, um, what it won't tell you directly. Um, they cut rates into a solid economy. They cut with inflation still elevated. They cut while acknowledging uncertainties about the neutral rate. That's not careful policy. That's a gamble, essentially, with you as an individual, your retirement. I'm Kevin Ross, and I'm here to guide you through economic complexities. This is Plan Life Right, where we decode Wall Street headlines into real world action.
And today we're taking you inside the Federal Reserve's actual meeting minutes, the stuff they don't want to emphasize. We're connecting dots nobody else is connecting: layoffs, premature Fed easing, tariff inflation, and what it means when the bond market stops believing the Fed. If you think the Fed will protect you, you need to hear this. Welcome to Plan Life Right, the podcast that gives you economic truth when everyone else is selling panic or false hope. I'm Matt Floyd, Director of Life and Annuities.
And I'm Kevin Ross. Matt, before we dive into this Fed's decision, I want our listeners to understand something critical about how central banks make mistakes.
What's that?
The Fed has a dual mandate here. They've got maximum employment and price stability and keeping inflation at around 2%. So when those two goals conflict, the Fed has to choose. On November 27th, they made that choice as someone with hawkish views in a monetary policy. It's deeply concerning to me.
And they chose, I'm guessing, jobs over inflation.
Yeah, and here's what their own minutes reveal. Participants indicated that they remained confident that inflation was moving substantially toward 2%. But core PCE inflation, the Fed's preferred measure, is 2.7%. It's been stuck there for 3 consecutive months. That's not moving sustainably. That's stalled.
Right. So they're declaring victory before they've actually won.
Yeah, and the history here is brutal to the central banks that do this. Um, Arthur Burns, back in the 70s, the Fed eased prematurely.
Mhm.
Inflation came roaring back, and it took Paul Volcker's recession in the early 80s to finally kill it.
So even if your job is perfectly secure, your retirement money might be at risk from a Fed policy mistake.
Yeah, your money is at risk when central banks prioritize short term pain relief for long term stability. And today, we're going to show you exactly what they did and why it matters to your retirement.
All right, Kevin, let's start with the data the Fed was looking at. What's the actual state of the economy?
So here's what makes the November rate cut to be so questionable. The economy isn't weak, it's solid. Real GDP growth in Q3 was 2.8%,
Mhm.
similar to Q2's pace. The Fed's own minutes state recent indicators suggest that economic activity has continued to expand at a solid pace.
So we're cutting rates into solid growth.
Yeah, it gets better. Their projections for the full year here in 2025 GDP were revised up, not down. Consumer spending remains strong, but business investments, they're continuing. So this isn't an economy that needs emergency stimulus.
But what about unemployment? Didn't that go up?
Yeah, to 4.1%, but that's what the minutes acknowledge. October jobs gains were held down noticeably by the effects of strikes and some hurricanes or something out there. They s- you know they've got all this disruption that's going on, layoffs. They're starting to continue to increase here. Um, so the job vacancy to unemployment ratio is, a little over 1%. So it's basically, kind of pre-pandemic.
Right. So the labor market is normalizing, it's not crashing.
Exactly. Yet multiple FOMC participants cited concerns that elevated risk that labor markets could deteriorate. Um, the translation here is we're cutting rates based on fear, what might happen, not what's actually happening. Yes, we're having job cuts, but it's not to the degree that, we're at 5 or 6%.
Right.
And we've been there before.
But what about the tech layoffs that we mentioned? 159,000 jobs. Isn't that concerning?
Well, the tech sector employs 6 to 7 million people. Okay. So 159,000 over 10 months is, about 2 to 3% of the tech
Yeah. And it's
workforce.
over 10 months. It's not all 159,000 walk out today.
Right.
Okay.
Right. It feels like it because what was it? Amazon just announced what, 30,000, I
Yeah.
think, and a couple others. It sounds like a big number, but then when you look at the overall employees,
Yeah.
not that big a
And it's
deal.
staggered. It's
It's
not all hitting at the same
right.
time.
Um, so it is it painful for those workers? Absolutely. An economic crisis signal? I don't think so. It's sector specific right now. There's specific adjustments after a massive pandemic overhiring, I think.
Right. So retail closures, the 2,700 stores that have closed. That's also sector specific.
Yeah, yeah, it's
Easy for me to say.
right. That e-commerce, the e-commerce is killing brick and mortar. I mean, every year you look at it, and we'll see it again this year. The data of online purchases, I think last year it was maybe 60%.
Yeah.
It's just going to go up
That's
from
just that
there.
just keeps happening. It has
Yeah,
been for a while, but it grabs headlines now.
right. So, and it's been happening over a decade.
Yeah.
Before, I remember s- seeing all the lines at 12 o'clock at
Yep.
Best Buy and Walmart to go get the big screens.
Yep.
And now you just click a button and have it delivered to you.
Exactly. Yeah.
You don't have to do any of that. So, I think, yes, the e-commerce is really having an effect on that. COVID accelerated it, especially in the restaurant business. A lot of them just couldn't return to profitability.
Right.
Why? Because of inflation. So it's not really economic weakness per se. It's really kind of a structural change
Yeah.
here.
It's a shift.
Yeah,
Yeah.
exactly. So now here's what I think we should worry the listeners. While the Fed focuses on hypothetical labor market risk, actual inflation is really still elevated.
And that's that 2.7% number that you mentioned, right?
Yeah, core PCE at 2.7, total PCE at 2.1. Housing services inflation that remains somewhat elevated. The minutes say participants expect housing inflation to slow eventually. That's not data, really. That's
Yeah,
hope.
it's hope, yeah. So they're cutting rates based on labor fears while inflation still remains above their target.
Yeah, and here's what really concerns me. Several participants noted the possibility that the process could take longer than previously expected. So they essentially admitted disinflation might stall and then cut rates anyway.
Kevin, you've read the full FOMC minutes. Take us inside the room. What were they actually thinking? I don't know if you want to dumb yourself down
Yeah,
too far.
I'm not going to get into some of this stuff. It's confusing, but I will read a couple excerpts from it. So let me read some of the exact language from their policy decision. Here's what it said: in support of its goals, the committee decided to lower the target range of the Fed fund rates by 25 basis points to a 4.5 to 4.75%. And it was a unanimous vote, not a single dissent in November. That bothered me.
But why does unanimity I'm not gonna even try to say that one
Unanimity.
again. Why does a unanimous vote bother you so much?
Because good monetary policy requires debate, hawks arguing against cuts, doves pushing for more accommodation. When everyone agrees, it usually means groupthink has taken over.
Mhm.
Um, the Fed was unanimous in 2007 that subprime mortgages were contained, which garbage as it played out.
Right.
They were unanimous in the 70s that inflation was transitory. Consensus isn't always right.
So there was no devil's advocate in the room to say, "Hey, let me take the counterpoint here just for giggles."
Right.
So what should they have done differently?
All right. So if a hawkish Fed, ones that's focused on finishing the inflation fight, would have said, we've made tremendous progress. Inflation is down from 9% to 2.7, but we're not at 2 yet. Let's pause. Let's let the previous rate hikes work through the economy and ensure inflation is truly defeated before we ease. Instead, what they did was they cut the 25 basis points in September. They cut another 25 in November. So that's 50 basis points in back to back months with the signal that more cuts are coming.
So what's the risk of cutting too soon?
All right. So in the 70s, Arthur Burns started easing back in 1976, thinking inflation was beaten. Within 2 years, inflation was back above 9%. It took Paul Volcker raising rates to 20% and causing a brutal recession to finally kill it.
The 20% rates?
Yeah, that's the cost of premature easing. It's always higher than the cost of staying restrictive slightly too long. And here's what's fascinating: the Fed's own minutes acknowledge this risk. They noted that monetary policy would need to balance the risk of easing policy too quickly, thereby possibly hindering further progress on inflation, with the risk of easing policy too slowly.
So they know they're taking a risk.
Yeah, they know, they admitted it, and they cut it anyway. Uh, multiple participants said the committee could cause its easing of the policy rate and hold it as a restrictive level if inflation remained elevated. So they're saying, we'll cut it now. And if we're wrong, we'll reverse course. That's not a plan, that's a coin flip with your retirement security.
Yeah. So that's like being on a diet and your goal is to lose 30 pounds and you're like, I'm at 20, let's go out to eat.
Yeah,
And
yeah.
then we'll go out to eat next week, and then we'll go out to eat the week after
Oh,
that. We'll go
okay.
to, and if I gain the weight back, I'll just diet harder on the other end.
Bingo.
Yeah. Well, you mentioned bond markets earlier. What are they saying?
So here's where it really gets interesting. The Fed cuts rates in September and November, a total of 50 basis points. The Treasury yields went up, not down. The 10-year Treasury yields rose notably over the period. The minutes say the rise was really primarily driven by increase in real yields.
So the Fed cuts rates and borrowing costs go up?
Yeah. Yeah, that's the bond market saying we don't believe you. When the Fed cuts, but yields rise, markets are saying either we expect stronger inflation ahead, or we've lost confidence in the Fed's credibility. Or
And the bond market, I'm guessing, has a lot more bankers and traders and economists in it than the Fed does.
right,
And the bond market is voting against the Fed's decision.
yeah, the minutes try to spin this positively. Factors driving the increase in yields included stronger than expected data releases. Here's the translation: the economy is stronger than the Fed wants to admit, which means rate cuts are premature.
For someone with retirement savings, what does this mean?
You're getting hit from both sides. The Fed cuts your savings yields and the CD rates, but long-term borrowing costs, the mortgages, the corporate bonds, they're not following because the bond market doesn't believe the cuts are justified. So you lose income on your safe money without getting the benefit of the lower long-term rates.
And that's the squeeze you mentioned in the opening.
Part of it. Now, yeah, the tariffs, they're raising your cost of living, get one time, but you've got that retiree vice, right? You put but before we get into the tariffs, let me show you some specific language in the Fed minutes that reveals, really their uncertainty.
Yeah, what did they say that makes you so sure they're unsure?
Here's what they said. Many participants observed that uncertainties concern the level of the neutral rate of interest, complicated by the assessment of the degree of restrictiveness of monetary policy. Does it sound like something a doctor would say to you? Like, I don't know what
translate that
or
for us normal people.
some lawyer would say. They can't make it easy. All right, so here's the neutral rate is the interest rate that neither stimulates nor restricts the economy.
So
Okay.
that's what it should be.
Yeah, it's kind of the Goldilocks rate. It's
Okay.
not too hot, it's not too cold.
Right.
But nobody knows what it is right now. The Fed's official estimate's around 3%, but they admitted they don't really know.
So they're cutting rates toward a target that they can't identify.
Yeah, they're flying blind, and their solution is to move gradually and hope that they figure it out along the way. A hawkish Fed would say, if we don't know where neutral is, let's be conservative. Let's stay restrictive longer and ensure inflation is dead. Then we'll slowly ease.
Okay. So they're hunting. They're shooting arrows into the woods thinking, man, there's a deer in there somewhere.
Yeah.
Gotta hit it eventually. So what's your prediction? We're into November. Are you thinking you'll see another cut in December or shortly after that?
Gosh, so this Fed, they could cut another 25 basis points in December. We know that already. They could bring rates down to 4%. But I think here's what's changed with this. The December statement is going to add language about the extent and the timing of further rate adjustments that the Fed speak, meaning we're slowing down.
Okay, so they're getting more cautious.
Yeah. So the updated, dot plot shows only two more cuts, or one more cut in 25 now, down from, you know, four. I think they previously projected, back in December of last year, right?
Yeah.
So, my fear is that they've already cut too much. Inflation resurges. If we see sticky services inflation, if tariffs add to price pressures, and they will momentarily, if wage growth accelerates, they'll have to reverse course dramatically, which is not their DNA.
And reversing course means hiking the rates again.
Yeah, potentially. Imagine you're a retiree who structured your life around 4% interest rates because the Fed said they were easy. Inflation jumps back to 4 to 5%. The Fed has to now hike rates to 6, 7% to fight it. This is devastating. Your cost of living just spiked. Your income planning really is broken. And the market correlation from the Fed, reversal destroys your portfolio.
Right.
It's, I think it's really the cost of premature easy.
All right, Kevin, we've talked about the Fed's questionable rate cuts, but there's another force hitting wallets: tariffs. The Fed is cutting rates supposedly to help the economy, but tariffs are raising prices. Explain how these two forces actually work against each other.
All right, so this is where retirees get crushed, Matt. Let me show you the mechanism. Start with the basics. A tariff tax is on imported goods. So when the U.S. puts a 25% tariff on steel, American companies pay 25% more for that steel,
Right.
and then they pass part of that on to the consumers.
So tariffs are effectively a consumption tax.
Well, tariffs create a one-time price level increase. Okay, it's not like inflation. If steel costs 25% more because of a tariff, that's a permanent step up in price, not an ongoing acceleration. Okay. But here's the problem: the Fed looks at overall inflation. So if tariffs push prices up, it makes their inflation numbers look worse. Even though it's not demand driven inflation, they can control that with interest.
So the Fed might have to keep rates higher because of tariff inflation.
Of course. And they cut rates thinking the economy is weak, but it's tariff driven inflation says it's elevated. So now you've got easy monetary policy adding to price pressures instead of fighting them.
Right.
Okay.
So what's actually getting more expensive because of tariffs?
All right. So let's look at categories where tariffs are biting us. Appliances like washing machines, dryers, refrigerators. These prices are up 5 to 8% on some of the models because of the steel and the components
Right.
of the tariffs. Electronics, the laptops, the smartphones, tariffs on Chinese tech components, they're adding cost, okay? Construction materials, steel, aluminum tariffs hitting building costs, flowing through the housing prices. Automobiles, cars are having, have thousands of imported parts. So tariffs on those components, they do add up fast.
So basically, if we don't grow it here or make it here, prices are going up.
Yeah.
And if you're a retiree trying to replace an appliance or buy a car,
Yeah, you're gonna pay the tariff tax, and if the Fed has, cut your CD rates from 5.5 to 4.5, you've lost income while your costs went up, okay? On $1 million portfolio, for example, that rate costs you $10,000 annually. If tariffs raise your cost of living 3%, that's another 1.5 to $2,000 on a $50,000 budget.
so you're down 11,500 to $12,000 total.
Yeah, every year, that's a, retiree vice, really.
But didn't you say some things got cheaper? What got cheaper?
Well, energy costs, have moderated from the 2022 peaks. Gasoline's
Yeah,
down.
gas is definitely down.
Yeah,
I can tell you that.
natural gas is way more stable. Used car prices, they've dropped quite a bit, which spiked during COVID. It was ridiculous then. They've fallen back to reality. Certain food categories where those supply chains have normalized.
So
Well,
it's not uniform inflation.
exactly. We've
Okay.
got sectorial price distortions, not broad-based 1970s style inflation spirals. The 70s had wage price spirals, okay? Prices go up, workers demand higher wages, business raises prices more, workers demand higher wages again. And they just got in this, feedback
Right.
loop,
Yeah.
right?
It's like a self licking ice cream cone.
Right.
But what about now?
So now we've got supply side price bumps, okay? Tariffs cause a one time jump. If they stay in place, price stabilizes at the new higher level. They don't keep accelerating like inflation. The Fed's betting they can cut rates without triggering demand driven inflation because supply constraints are easy.
And do you think they're right?
Well, I hope so. But here's
Hope's
what
not a plan.
that's right. That's right. Hope is not a
Hope
plan.
doesn't happen fast, but life does.
Yeah, but here's what really worries me. The minutes list several upside inflation risks that they're downplaying. Okay. Here's something else that came from the mid sudden disruptions in global supply chains due to geopolitical developments, stronger than expected consumption, more persistent shelter price increases, or sharp rises in insurance charges.
And those all sound plausible.
Yeah. Middle East tensions, China, Taiwan, Ukraine, any of these could disrupt supply chains overnight. The Fed cuts rates. The Fed cuts rates thinking they're preventing recession. Then you get a supply shock. It hits. Now they've got loose monetary policy pouring fuel on the inflation fire. That's what works.
Yeah, and they have to reverse course pretty fast.
Yeah, this is what destroys markets. It breaks retirement plans. It proves premature easing was a mistake. And that's why in the next episode we're doing a complete tariff deep dive where we'll show you exactly which categories are affected, what might get cheaper if tariffs are rolled back, and how to calculate your personal tax tariff.
And we'll talk about hedging in this retirement planning, I'm hoping, right?
Yeah, exactly. Because if you can't control tariff policy, but you can control how it affects your finances, okay?
Well, Kevin, step back for a second. We've talked about questionable Fed cuts, tariff inflation, and bond market skepticism, but they're all connected, aren't they? What's the pattern that you're seeing?
Well, Matt, this is exactly the kind of analysis in all of my years in the market, it's taught me. Let me show you a pattern here. Okay, so step one, economic data shows moderate softening, job growth slowing, and some sectors laying off, but nothing catastrophic
Okay,
here.
that's where we are right now.
Yes, and then step two, the Fed panics prematurely. The labor market risk and cuts aggressively. You know, 50 basis points, 25, 25, back to back. And then step three, financial conditions ease dramatically. Equity prices hit new highs. Credit spreads narrow. Risk appetites increase. The minutes confirm this. Broad equity price indexes increased notably here. Credit spreads for both corporate and municipal bonds have narrowed.
So the Fed eased and the markets got even frothier?
Yeah. Meanwhile, uh, the staff's financial stability assessment says that asset valuations are elevated with estimates of risk premiums across key markets lower by historical that are low by historical standards. So they're cutting rates into already elevated valuations here.
Yeah, that sounds like bubble territory.
Yeah. So here, step four: inflation stops falling. Okay, it stalls at 2.7. Tariffs keep certain prices elevated. The Fed cuts start adding to demand without supply catching up. Okay, and then look at the next step: inflation resurges. The Fed has to reverse course. The markets crash. Recession hits anyway. And now it's worse because they wasted their ammunition too
So,
early.
do you think this is inevitable?
I don't know that it's not necessarily inevitable, but it's definitely plausible enough to prepare for
Right.
sure. The key differences, from the '70s is, we look at what we didn't know. We didn't know all the conditions of the 1970s, or we don't have all those conditions. Inflation expectations are better anchored than they were then. The Fed has more credibility for now, anyway. And we don't have economy wide wage escalators built into contracts like we did back then.
Right. So you're thinking probably not stagflation, right?
My favorite one. If for the economy as a whole, probably manageable with some discomfort. Okay. For individual retirees who planned on a 5% safe return and a 2% inflation, and instead get a 3% return and a 4% inflation,
Yeah, that's devastating.
yeah, you're playing breaks, right? You don't realize it until you're 75 and you're running out of money.
And got to go dust off that resume and hit the open job market again.
Yeah. So what do you got to do, right? You got to stop hoping the Fed protects you. Stop assuming inflation is going to stay low. You've got to stop guessing. You got to start locking in guarantees while they're still available here.
All right, Kevin, we've painted a concerning picture: premature Fed cuts, potential inflation resurgence, tariff pressures, bond market skepticism. What's the solution for someone listening right now?
Yeah, the solution's the same as it's always been, Matt. It's you got to lock in the certainty while the uncertainty is your enemy.
So let's break that down.
All right. So most retirement plans are built on assumptions, right? The Fed will keep rates low. Inflation will stay at 2%. The stock market will average 8%. The problem here is every assumption we've discussed today is questionable. The Fed might have to reverse course. Inflation might resurge. Markets are elevated valuations with low risk premiums right now.
So instead of assuming,
You got to lock in your guarantees right now. Today, they're fixed annuities, uh, still around the 6% level. I know those are getting ready to change. Um, that's not average, it's not projected, it's guaranteed right now, contractual in writing. So it won't change the next year. You're locking it in.
right,
Even if it's 585, it's still a really good rate
right.
comparatively speaking over the last history of the
So
last 30 years.
if the Fed has to reverse course and rates hike back to 6% to fight resurgent inflation.
Yeah, your 6% doesn't change. You've locked it in. If tariffs push your cost of living up 3% annually, the stock market corrects 30% because the Fed reverses course. If we enter a recession because they tighten too late, your 6%, fortunately, keeps on compounding. Your income doesn't change there.
But Kevin, what if rates go even higher? What if I lock in 6% and rates go up to 8%?
Yeah, wrong question, Matt. Based on everything we've discussed, what's more likely? Scenario one, rates go higher. The Fed cuts 75 basis points in two meetings. Market expects more cuts. They admitted the uncertainty about neutral rates. And so for rates to hit 8, they have to completely reverse course and hike 400 basis points. So if you've locked in 6 and rates somehow at 8%, you've missed 2% for however long it takes to get there.
Yeah, that rate hike wouldn't be overnight. It would take them a
Bingo.
year or two to get up to that
That's
point.
right.
Okay. So, what's scenario two?
Okay. So the Fed continues to cut with the December 25 and then first quarter 26.
Right.
Rates drop to the 3 to 4% like they did in '09 to 21. Now you're devastated and even lower. Actually, you waited for higher rates. Instead, you're getting 3% for potentially a decade. You just gave up 3% annually for 10 years. So on $1 million, that's $30,000 per year. That's $300,000 over a decade.
Wow. So the risk of waiting is way bigger than the risk of locking it in now.
Yeah. So at 60-year-old, at 60 years old, your job isn't to maximize every possible return. Your job is not to get poor. Yeah.
To maximize how much you hang on
Yeah,
to.
that's right. You got to lock in a good enough guarantee that protects you from every scenario that we've discussed today.
And what about, a product that gives you growth and protection? You got to risk it to get the biscuits. Isn't that what they always say?
Right, right. So, look, I'm a big believer in indexed annuities. They link your return to the S&P 500. Yes, they've got caps, but they also have the zero floor. So, when the market goes up, you participate up to a cap. And, right now we got a product that's guaranteed for the whole length of the term of the policy of an 8.75 cap.
Right.
Okay.
If you're listening to this, that price is probably not going to last with these
That's
rate
right.
cuts. So you better get on it quick.
But, so here's the cool thing though. You lock in the gains on your anniversary. Then when the market crashes because the Fed reverses course or a recession hits, you simply get a zero, not a negative. You get a zero. And then because of the reset, you don't have to make up the losses like
Right.
you do in the marketplace.
So back in 2022, when stocks dropped 18%.
Yeah. So indexed annuities had zero loss. You ended the year actually where you started while everyone else lost thousands of dollars. So let me tell you about a couple. They're in their late 50s. They came in, like 2021, right before the Fed started hiking.
What was their situation?
So they had like 750,000 in traditional investments, way overexposed to the market. Um, and as the Fed was about to implement this fast rate hiking cycle, and actually the fastest in 40 years, right?
Yeah. What did you do for them?
We moved like 400,000 into a combination of fixed indexed annuities. We left 350 for growth because they're still young enough. They've got time.
Right.
So that 400,000 guaranteed their baseline lifestyle, no matter what the Fed did.
So how did they fare when the Fed hiked rates and crashed both stocks and bonds in 2022?
Well, so their growth portfolio did drop like everyone's. Painful, but not catastrophic because they had money in their guaranteed accounts that kept growing. Um, I remember the guy calling, "Hey, should we be worried?" Because of course they're hearing all the doom and gloom. And I told him, "Look, we are in guaranteed account statements. Everything's on the income side are ratcheting up with the guarantees."
Right. So
Okay,
while everyone else was panicking.
yeah, yeah, they were fine.
Yeah.
So um, I remember the spouse says, "This is the first time in our lives that we don't really care what the Fed does. We don't
Must
really
be
have to."
nice.
Yeah. We know that our income is locked in. So they had that peace of mind.
And that's planning right.
Yeah, it's not about beating the market, man. It's about beating not being worried.
Well, Kevin, I know some listeners are thinking my financial advisor says annuities have high fees, limited liquidity, poor returns. How do you respond to that?
Well, let me tell you why most financial advisors hate annuities. It's not complicated. They get paid their management fee, typically 1.5% annually on the assets they manage. So if you have 500,000 with the advisor, they're earning 5,000 a year. That's fair. But
If you move that 500,000 into an annuity,
they lose their $5,000 annual fee. And you talk to advisors all the time, they get all caught up in this thing. But over 20 years, that advisor would have earned 100,000 from managing your money, not counting market growth and increasing their fees.
right?
There's zero ongoing fees to you in an indexed annuity. The insurance company pays the agent one time. So here's the key. And I know you talk to the advisors,
Mhm.
and we train to it is you're just moving part of the asset into a guaranteed, which then allows you as the advisor to be more aggressive so
Right.
that you can do what you're doing and double that money while you solve for their income needs down the road, right? Their
Right.
basics.
Yeah, it's kind of you got to come up with their sleep at night number, as we call it.
Yeah, exactly.
Because then your client calls you. If you're a financial advisor, your client calls you. Oh my God, the market's going down. I'm like, yeah, but you're not worried about that. Remember, we
Right,
already solved. You're not going to have to go back to work or move or start rationing your own groceries because we've already accounted for the income piece of it during
right.
your retirement. Maybe the grandkids get a little bit less. That's it. That's what you're talking about when the market goes down with
Yeah.
a properly structured plan. Um, so for a financial advisor recommending against annuities, would you say it's a conflict of interest because he's paid based on how much money he gets to manage of yours?
Yeah, I think it's a massive conflict. And when someone's paycheck depends on you not doing something, I think you should question their advice. I mean, it these they'll say, "Well, I'm a fiduciary." Well, a fiduciary looks at the whole plan of their
Right.
client, right? So insurance is part of being a fiduciary, and if they're not looking at long-term care insurance, which when you have the
That'll bankrupt you.
discussions, they're
Yeah,
like
it'll bankrupt
they're
you.
like
Yeah.
they don't even. That's when they'll hang up on you because they don't want to have that discussion because they're like, I don't have a, I don't have a I don't have anything that can guarantee
Right.
against long-term care. And so Matt deals with this every day because he's on with advisors every day. If you're listening to this and you got an advisor and he hates annuities and you've got, uh, one of your parents that have needed long-term care and there's a 70% chance that you or your spouse or one of your parents have needed long-term care, um, ask him that question. And then how's he going to guarantee that increase in income?
Right.
If they're going to let it all ride, and we've just talked about the Fed overstimulating the marketplace and what that can do in the long term to the market, y- now your income's at risk,
Right.
right? And if you go in a nursing home, now what are you going to do with it? It's going to bankrupt you. And now you're doing the
Right, and they don't have to
government
always be an income solution. We've talked about even
right,
just using a regular annuity
to
and
protect
using
the assets. It's a
withdrawals.
bond
Yeah.
alternative,
Yeah, use the withdrawal out of the annuity to fund the long-term care.
right?
And hey, maybe you're one of the 3 out of 10 people that won't need long-term care
Right.
insurance,
Yeah.
but you plan for it anyway. Great. That's
Right.
legacy money you're leaving to your family. You
That's
never
right.
had to touch it. Or later in life, you're
Yeah.
single, widowed,
It,
Want to go on a cruise around the world? You got a $250,000 annuity you never tapped into. Go ahead, tap into
yeah,
it. You know.
or use the money off of your the money that's grown. But you did say something here. I want to make sure everybody. Matt said if you're one of the 3 out of 10 that don't have to use long term care, 3 out of 10. I mean, 7 out of 10. Something's going to cause you to need some type of long-term care or assistance as you get older, which costs money.
Yeah.
So everyone should plan for it. You have a higher probability of needing some type of long-term care feature than you do being in an auto accident
Right.
or your house burning down. And in our place in Tampa, you getting hit by a hurricane. You have a way higher, and you have insurance and all of that.
Right.
And we choose not to do anything to address long-term care. And you don't have to buy the standalone long-term care insurance.
Right. That's very expensive. Yeah.
It's way expensive. Yes.
Yeah. So I'd say if your financial advisor is not talking to you about long-term care or
Yeah.
a plan for long-term care,
Fire
he
'em.
hasn't thought of it. He doesn't have a plan for it. He's hoping you don't need it. And like we always say, hope is not a plan.
That's right.
It's the absence of one, I guess.
Yeah, that's exactly right.
So what about actual criticisms? And I know these products are out there. The annuities that do have high fees,
Yeah,
because
so
those do exist.
so variable annuities that have been sold by the Wall Street firms that they can have. They're going to tell you it's a 2%. Well, that's the M&E and the other fees, but you also have the management fees inside because they're
1%.
mutual funds with an
They're just
insurance
like all
wrapper.
managed money. Yeah.
So you're really at a 3 to 4% annual fee on a variable annuity, and they're terrible. The truth here is the fixed and indexed annuities, they've got zero ongoing fees in most cases. You're not paying at 2, 3, 4% every year forever. They are riders that you can buy, right? But you don't have to. You can opt out of those.
Exactly. And you're not paying that 1% to your money manager every year.
That's
like
right.
clockwork. It's like pass and go
Right.
on Monopoly. He gets his 1%. Whether he lost your money or made you money, you give him 1%
Yeah.
either way.
Or your variable annuities at 3 to 4%.
And what about limited liquidity? Because that does come up
Yeah.
sometimes.
All right. So most annuities have surrender periods, 5 to 10 years. There's early withdrawal penalties if you pull everything out. Okay. That's what that means. But if you're 60 years old and you're putting money in a retirement account, should you be pulling it or planning to pull it out in 3 years anyway? I think it's a feature, plus just about every annuity out there lets you withdraw up to 10% annually, penalty free. So you're not locked out. You're protected from panic selling during crashes. I call it the only product out there with a predictable out.
Right.
You know what the surrender charge is if you decided 3 years in you wanted to lump sum it out. Hopefully, you've got a good advisor that's discouraging you to do that,
Yeah.
right? To keep it in there.
And I don't know of an advisor if you asked him, hey, what's my stock going to be 3 years from now? I
Right.
don't think he could even hit it with a dart on a dartboard.
No.
But he
And it's
couldn't
a
tell you you're
total
definitely
guess.
not going to lose more than 5%. I can guarantee
That's
you
right.
that. And that's what an annuity with a surrender
That's
window,
right.
a surrender
Exactly.
charge is.
Gives you a predictable
And
out.
that protection from the panic selling, that's actually a good thing, right?
Yeah, it protects you from, your worst instincts, what the Fed reverses course in the market, or, when the Fed does reverse course and the markets crash, right?
And poor returns. I think that's what I get the most from these money guys. Like,
Yeah.
oh, I can do better in the S&P 500.
Right. Yeah. And
can't do better
they
than
do
zero in a
until
down
they
year, though.
don't, and
Exactly. Yeah.
and that's what I've always told advisors over the years. It's like when you're selling your performance, you will lose money in the long run. You will lose clients because no one outperforms the market consistently.
Right.
It's never
It's just
been
not
there.
possible.
It's
Yeah.
impossible. So, you show me a safe investment that's paying 6 or 5.5% guaranteed right now. You can't. It doesn't exist outside of fixed annuities, right? And with the Fed cutting rates, we know that 6% they're disappearing, right?
Yeah, I'd say you probably got a week or two left at most. If
Yeah.
you're listening to this, you probably got about 14 days to lock in a 6%.
Yeah.
And we might not see 6% for a while.
Yeah, and there's several companies that we're seeing every week that are having to drop rates.
And the ones that aren't doing it this week or this month, they're gonna do it next month. Yeah,
Exactly.
we've been in this long enough, we know how it goes. They
It,
all follow each other.
yeah, and for you CD lovers out there, you already felt it because they've already lowered CDs. So,
Exactly. Well, Kevin, if someone's listening right now thinking, "God, I need to do something," what is step 1?
all right. So first, understand we're in a unique moment in economic history. I think the Fed has started cutting. Bond markets are skeptical. Inflation remains elevated, and guaranteed rates are still really relatively high. But the window for sure is closing.
Yeah, I might have jumped in saying you got 2 weeks left,
Yeah.
but how fast is that window closing?
Well, so first understand we're at a unique moment in economic history. Interest rates are still relatively high compared to '09 to
Right.
2021, that what 13 years. Um, that means that guaranteed rates are still relatively attractive. But again, like I said, the window's closing.
How fast is it closing?
So they've cut September, cut in
November.
November. Are they going to cut in December? So insurance companies adjust their guaranteed rates based on Treasury yields, right? So that 6% guaranteed available today, could be 4.5, 4%, maybe even lower mid 26.
Yeah, and on $1 million, that 1.5 to 2%, that's 15 to 20 grand a year. Not just a one-time $15,000 off
Right.
the top, it's 15,000 a year.
Every year for life. And that's potentially look at 300 to 600,000 in a lifetime of income that you're leaving on the table by waiting.
So what should people do right now?
I would say go to planliferight.com. We built 3 calculators specifically for this environment. Doesn't cost anything to use the environments. You can put in your own kind of numbers in there and, you know, mess around. So for one of them, we got a MIGA rate engine that shows you what the guaranteed rates are right now that you can lock in today. And then, you know, how long how long they'll be available.
Those
2,
numbers are changing
they're,
quick.
they're they're changing quick. So, um, look at it. And then if you need to have a conversation, click on appointment and we'll have a discussion with
Right.
you because we're going to know up to the minute who's cutting, who's not. Second, we've got a tax deferred CD estimator, which shows how Fed rate cuts will impact your safe money income over time. Okay. And then the third one's your retirement income gap calculator, which shows whether, tariff inflation creates a shortfall in your plan.
Right. And here's where everybody's waiting for the catch. Are these free calculators or they got to subscribe to
Completely
something?
free, no credit card required, just information so you can make educated decisions. And if you want our team to walk you through your specific situation, you book a free consultation, and we'll show you exactly how these forces can affect your retirement and what you can do about it.
Yeah. So, how long will these rates be available? Is it like gone here today, gone tomorrow? Are we in that environment yet?
Yeah, I mean, insurance companies could change rates with a 1 week, 2 week notice, right?
Right.
And we've already started seeing, several companies start dropping their rates in the last couple of weeks,
Yeah.
right?
We got a notice today. Prices are changing 7 days from now.
Right. And so, waiting literally could cost you thousands of dollars, per year for the life. All right, Matt. I've been doing this for a very long time, and I've never seen guaranteed rates this attractive relative to market risk. And I don't expect to see them again once the Fed enters their full cutting cycle.
Well, Kevin, this has been eye opening. We've covered a lot of ground on this episode.
Yeah, Matt, layoffs, they're going to come and go. They always have. The Feds will cut rates and eventually raise them again. Tariffs will be implemented and negotiated and
Yeah,
changed.
stocks will go up and then they'll go down,
Yep.
then they'll go back up again.
Yeah. But here's the thing, your retirement security isn't determined by those headlines, it's determined by the decisions you make today.
Right. You can't control the economy.
Right. You can't control the Fed. You can't control tariff policy. You can't control whether your employee lays people off. But here's what you can control, you can control your plan. You can choose guarantees over hope. You can lock in certainties while it's available. You can protect your family from economic chaos that will crush other people.
So if you're tired of watching your retirement depend on headlines you can't control, or if you just want to sleep a little bit better at night, go to planliferight.com right now. Run those free calculators, get the data, take control of what you actually can control.
And, remember, the Fed's job is to save the economy, not your retirement. That job, that's yours.
Yeah. Thanks for listening to Plan Life Right. I'm Matt Floyd.
And I'm Kevin Ross.
Life happens fast.
The question is, will you plan life right?
Next week, our deep dive tariff special. I know we've had a lot of folks waiting for that one. We're breaking down every major tariff category, showing you what's really getting more expensive, what actually might be getting cheaper, and how to calculate your personal tariff tax. If this episode helped you understand what's really happening in the economy, share it with someone who needs clarity. They'll thank you. And go run those calculators. PlanLifeRight.com. We'll see you here next week.